you guys want to kick it off, you guys are more than welcome to.
Hey, good morning, everybody. I want to welcome you to today's event. You got John Hopkins and Tom Bowley here. He's going to jump in just a second. I want to first welcome everybody to today's event. Thank you for taking the time to join us. One thing we love to do right off the bat is find out where everybody's from. So in the chat, if you could just post where you're beaming in from. I'm in Charleston. Tom is in Charlotte, and I know we have people all over the world, so it's really great for you to join us. I want to let you know that today's recording event will be recorded like all of our events are. If for some reason you're unable to stick around, don't even worry about it. You will get a copy of this recording, and it's just going to be chock full of great information. We've got a lot of new faces in here today. I really want to thank you for stopping by, and I want to thank our wonderful members who've been with us for some of them many, many years. And one thing I want to do is mention real quickly that we will.
Nope, we already lost him.
Oh, there he went.
There he went is right. That's funny. All right. I guess you can go ahead and keep on talking, Tom. Do the intro.
Yeah, that's fine. John having a little bit of internet difficulties. That's fine. We'll get him back in here in a minute. I think John just wanted to point out. Well, we got him back. You there, John?
Yeah, I just want to mention we're going to have a great sale. We have a tremendous event coming up, our Market Vision event, the beginning of January. And we want to reward people who came in today with a great opportunity to save some money. So we'll talk about that a little bit later. But I know we should probably just jump in and talk about the agenda. Oh, one other thing. If you like the video here, make sure you subscribe to our channel. It's really growing, and we appreciate it. Tom, you want to quickly talk about the agenda?
Yeah, I'll go through and talk about some of the things that we're going to discuss today. First of all, I love these events. Thank you all so much for coming out on a Saturday morning. I saw one of the comments saying it was 9 a.m. It's too early in the morning. First of all, we had to do it a little early. I know we got a lot of folks out there probably want to watch college football playoffs. They start around noon. I certainly don't want to run into that. I want to watch them. So I'll be sure try to make this as quick as possible. I would say it's probably going to run at least an hour, might go an hour and a half, but I'll try to cap it there at the absolute most. So again, just want to thank you all for taking time out of your Saturday. I certainly appreciate that. I think it's time well spent. If you follow and you're doing a lot of investing on your own, you know how difficult it is out there. I think one of the things that we're really good at Earnings Beats and really separates us from a lot of our competitors is our guidance. And we're going to talk about that a little bit later in the show. But I think some of the calls that we've made, both tops and bottoms, have been spot on. I don't think it's coincidence. We do a lot of research. I've studied the market most of my life. And I do it because I want to try to figure it out. I want to try and it's my nature. I was practicing CPA for 20 years, was in public accounting for a long, long time. I love to analyze. And so for me, the stock market's just one more opportunity to analyze and try to conquer. What I have found is that trying to conquer is really difficult, but we analyze, we do the best we can, and we move on. But let's go ahead and go through the agenda here. First off, again, welcome, just the introduction. John and I have been doing this for 21 years. Absolutely love it. We added Matt and my daughter Erin and Chris, or John's son Chris, has been with us pretty much since the inception, part-time. But now all of us are full-time in the business, and it's such a great team. And I think many of you that have worked with us know how dedicated all of our team is. So it's really just great to get everybody together this morning. I'm going to start off today. I'm going to talk a little bit about where we stand in the market. And I think the hardest thing about talking about a possible sell-off and pullback is that most folks, when you look at the market, you just get accustomed to the way it feels right now. So when the market's going up, you just don't realize there could be trouble out there brewing. And when the market's going down, you don't even want to think about talking about a bottom and the fact that we're going to go back to all-time highs, because you can't really get past the losses that are in your account and the stress and all that causes for you personally. So what we do, and one of the things I think we're really good at, is looking beyond what we're just seeing in terms of the technicals, current technicals, and looking below the surface and finding out when the market's going down, when it actually starting to get better, even though it doesn't feel it. And the same thing with the tops. Tops are much harder to call because, as I mentioned before, I think topping is a process. Bottoms, a lot of times, capitulation. So you can literally point to a candlestick and say, yep, that was the bottom. The top is much more difficult because, again, Wall Street's kind of maneuvering, rotating out of aggressive areas into more defensive areas, and it takes time. You can't just reposition trillions and trillions of dollars in one day. And so I think we're kind of in a process right now, and I'll talk about that more as we go through. But then we got the technical outlook for the prior tops. What did it look like prior? Is it, similar to what we have now? Then we're going to get into sustainability ratios. This, more than anything else, this is kind of my go-to. If I have a go-to, it's probably the sustainability ratios, which just tells me if the S&P 500 is going in one direction or the other, is that move sustainable? In other words, should we trust it or should we not trust it? I want to talk about that. Crypto signal. I don't really talk about cryptos that often. I don't trade cryptos, but at the same time, cryptos help provide us some pretty important clues about equities, U.S. Equities. So talk about that. The semiconductor role in the S&P 500 and how that plays into all of this. We're going to wrap up with the S&P 500 channel that we've been in since 2009, show you where we are right now and what that might mean. And then we'll talk briefly about Market Vision 2026, because really this is the lead up to our biggest event of the year. Market Vision 2026. This will be our 7th year of forecasting the year. And the one thing that I have not done in the last 6 years, unlike just about every analyst out there, I have never once during the year changed my target. Didn't matter with the pandemic. It didn't matter with the cyclical bear market of 2022. It didn't matter earlier in 2025 when we had the big sell-off. I already had factored all that. Well, I didn't really factor in the pandemic. I'll be honest. I didn't know anything about, what was going to happen there. But the market ultimately goes where it is supposed to go. I don't know if that makes sense, but when you follow the market as closely as I do and you use perspective, because that's one thing that seems to be lacking a lot of times when you get in the middle of the market going up or you get in the middle of the market selling off big time, it's really hard to maintain that long-term perspective. But the way we look at the market and the way we do our forecast, that's exactly what we bank on. So anyway, I was looking at a lot of the folks before we get into the action. I see a lot of the folks responding where they're from. I mean, literally all over the world. This is the greatest thing about doing these online events. The worst thing is losing a connection, like we saw with John a little bit earlier. The best thing, though, is bringing everybody from around the world together in one session. I mean, if we were going to have a live event where it was in person, obviously a lot of folks wouldn't be there. But in this way, we're able to bring everybody together. But I'm looking, I saw Belgium, I saw Calgary. We've got a lot of friends to the north in Canada. I saw Germany, my home state, Maryland. That's where I grew up in the Maryland area. Was born in Washington, D.C., lived in Maryland and Virginia most of my life. Now I'm down a little bit south of Charlotte, North Carolina. But I saw somebody from Gilligan Island. I used to watch that show, tell the captain, the skipper. I said hello. What else we have? We got Albuquerque, New Mexico. We got all over the U.S., which is really interesting. We got Thailand. Just crazy. I mean, so many folks from so many different places. So again, thank you all so much. So let me pull up my charts here. We're going to get into this. Bear with me one second. So we're going to start off with the current outlook and just taking a look at what the charts are doing right now. So all right. There we go. All right, so let's take a look. Where are we right now? And I'm going to go through the major indices real quick and just show you that on the surface, there's really not anything that you should be concerned. I mean, if you're just looking at technicals, and if you know anything about a trend is just nothing more than a series of higher highs and higher lows. And when I go through these major indices, I want you just to look at these and see if on the surface you see any problems. I mean, here's the Dow. I mean, I'm seeing higher highs and higher lows just recently. Last week or so, set a new high. So, we've pulled back. We pulled back a little bit here in the last week and a half, but still we're in a nice uptrend. There's nothing wrong here with the Dow. Look at the PPO coming off the center line, starting to strengthen again. That's telling us that the short-term moving average is pulling away from the long-term moving average. That's a sign of improving momentum, bullish momentum. Nothing wrong here on the Dow. Dow looks great. How about the S&P 500? Same thing. I mean, I'm looking at recent lows. We had kind of equal lows there. Prior to that, we had a couple lows down around, 63.50 or so. These two lows around 65 and a half, 65 and a quarter. I don't know exactly what the low was. Pretty close to those areas though. And look at where we are right now. We finished strong on Friday. We're within 1% of breaking out to another all-time high. What could go wrong, right? I mean, this is technical analysis. Again, folks looking at price action, I could look at this and say, well, we got a nice uptrend, maybe a little bit of a cup handle, breakout, looks like, looks good. How about NASDAQ? Here's NASDAQ 100. A little bit more aggressive. Notice the lows here are actually a lower low. So as we're getting more aggressive in the indices, we're seeing a little bit more weakness in the November low versus the October low. But still, for the most part, we're still moving higher, still in an uptrend. Got a little bit more work to do to get back above 26,000. Here, we probably need about 3% on the NASDAQ 100 in order to get to an all-time high. S&P 500, only 1%. So you can kind of see there's just a little bit of deterioration in the more aggressive NASDAQ. And then we go to the IWM, Russell 2000, which to me is probably one of the healthier of the major indices. We broke out like the Dow a little over a week ago, all-time high. We pulled back. We're kind of holding the rising 20-day moving average. And it looks to me like we're ready to kind of move back up and challenge the recent highs. The Russell 2000, probably about 2 percentage points, maybe a little bit more than 2% away from its all-time high. So as we're looking at this isn't bad action. No one's panicking in the market, right? Everything looks good. What's to worry about? Well, let me show you the 2025 top earlier this year, February 19th. This is where we were. Now I'm going to go back. Let's go back to the S&P 500 because here was the February top. And this is what happened on the heels of it. Now we can look back with hindsight and say, yeah, man, that was time to get out. February 19th. Well, we actually went to cash in earnings beats back at the end of January. We started warning our members at the end of January. And I'll talk about why in just a little bit. But let's go back now to that top. So this is where we were, February 19th. What on this chart looks any different than what, right now? I just said, chart looks pretty good. We got the PPO above the center line turning up. Looks like momentum is picking up to the upside. We just broken out to an all-time high. What's not to like on February 19th? Look good. Again, technicals weren't telling us anything here. How about the January 3rd, 2022 top? We had just had the Santa Claus rally. And I mentioned that because technically the Santa Claus rally starts on Monday. It's one of the most bullish times of the years from December 21st to December 31st. One of the best times to be invested in the market historically. Not that it goes up every year, but historically. And that was a nice Santa Claus rally at the end of 2021, leading us to a high on January 3rd, an all-time high. First time, I think, closing at almost, actually maybe I think the actual high intraday was on January 4th, but I think this was the closing high. Anyhow, what's wrong with this technical picture? Look at the PPO coming off a center line reset, moving straight up, short-term moving average, pulling away from the long-term moving average. That was at the start of 2022. And on that, well, actually it was the following, I think it was Saturday, might have been like the Saturday, January 8th or the 7th. I don't know what, something like that. I talked about the fact that I thought the market was going to drop 20 to 25% in the next 3 to 6 months. And yet when you look at the technicals, and if you listen to CNBC, they're partying like it's 1999, literally 1999. Anyhow, it was the under the surface signals that alerted us. And that's why we're having this session today, because I want you to understand that it's not all about the current technicals and just looking at the S&P 500. Wall Street, when we're getting ready to have weakness, Wall Street just doesn't sit back and say, oh, well, we're just going to let our portfolios drop too. What they do is they move out of the aggressive areas and they move into defensive areas. And they do it all the while you've got the S&P 500 moving to all-time highs. You can't see what they're doing. And do you think they're going to come on CNBC and tell you that, oh, we see things going much lower over the next 6 months, so we're getting out? They're not going to tell you, because it takes them a while because of the money that they have to unload. We're talking trillions of dollars. If they tell us and we all get out at the top, how do they get out? How do they reposition? They can't. So, and that's the way Wall Street's set up. Unfortunately, there's a conflict of interest where Wall Street's managing their own money. They're also investing for many of their rich clients. They have a market making unit. So they're doing the opposite of whatever it is that they're telling us to do. And how do they tell us what to do? They send their analysts on to CNBC, and they're in the media everywhere. They call them analysts. I call them influencers. I don't trust any of them, because I have seen them going on CNBC and talking bullishly while I'm looking at the charts and I'm seeing money rotate away from aggressive areas to defensive areas. So why go on to CNBC and tell everybody, oh, all-time high, things are great. In the meantime, on the charts, money's rotating into more defensive areas. And then later, after we move lower, they'll tell us about how bad things are. And, oh, by the way, yeah, I did expect that the market was going to go up to X, but now I'm going to lower my forecast. I'm going to bring it down. And so then they start spreading the fear. And that's just the way the market works. All right, let's keep moving. So here are the sustainability ratios that I like to follow. Now, this is where we currently sit. And then I'm going to show you where we were at the beginning of 2025 when we moved to the sidelines and told members to be careful. And then I'm going to show you 2022, where we did the exact same thing. When we were sitting at an all-time high, we got defensive and even called for a bear market before it started. So let's take a look. This is some of the sustainability ratios that I like to follow. So the first part here is the S&P 500. Notice S&P 500 going up since April. Nothing wrong with the market. And here we are sideways consolidating, starting to make a move up. And you know what? I think there's a reasonable chance over the holidays we could set an all-time high. I would not be surprised. And my target for this year on the S&P 500 that I set all the way back on January 4th or whenever it was 7,000. And at the beginning of the year, I called for a correction in the first quarter. Here was the correction in the first quarter. And then right at the beginning of April, we had 3 bad days that took us down to barely reaching bear market territory. But essentially what we did is we had a correction and a recovery, and now we're moving back towards 7,000. That was almost exactly what I said at the beginning of the year. And again, it has nothing to do with listening to CNBC. It has everything to do with following the charts, looking at the way the money is rotating, following sentiment indicators, which I'll talk about a lot at the Market Vision event in a couple of weeks, and perspective, a heavy dose of perspective. That's probably as important as anything. Just being able to take a step back, get away from the emotions of having your money invested and watching it go up and down like a yo-yo sometimes, trying to step back away from that and look at the long-term picture. That's a big part of calling the market. Anyhow, so here we got the S&P 500. We're almost where we were at the end of October. We're 1% lower. Effectively, we're almost at the same spot. But the market underneath the surface is nowhere near the same spot. Let me show you what I'm talking about. Here is the QQQ versus the S&P 500. QQQ versus a spider. So what this does is it's just telling us the relative performance of the more aggressive NASDAQ versus somewhat aggressive S&P 500, but not as aggressive. The aggressive areas like technology and communication services, think semiconductors, internet stocks, those types of companies, much, much bigger representation on the NASDAQ than on the S&P 500. So everything looks good here. The ratio is going up with the S&P 500. That's what we want to see. That tells us that the market environment is risk on. Risk on meaning that it's the aggressive areas that are going up, driving the market higher. That is what drives bull markets. It's the risk on, the aggressiveness of traders. When we start to see the market turn more defensive, that's when we've got to be a little bit careful, because that's how bigger drops start. So anyway, QQQ versus spider looks good. Next one, XLY versus XLP, consumer discretionary. These are companies that sell us the things we want versus consumer staples, which are the companies that sell us the things we need. Staples companies, if you think about toothpaste, deodorant, soap, these are things we need, not that we want. Well, I hope you probably want them too, but you need them. It doesn't matter whether the market's going up or down. You still should put deodorant on every day. You still should brush your teeth. You should still bathe. Right? So I've never once in my life said, you know what, the market's really strong. I'm going to go out and I'm going to get more soap. I'm going to bathe twice as much today. It doesn't happen, right? So the consumer staples companies are very consistent in their earnings. Discretionary companies, however, are much more subject to the economy. If people start losing their jobs, if they're not making the money they were making, if they feel worse, the stock market starts to go down. Jobs are lost. They're feeling worse about their overall wealth. How do you think that impacts buying products from companies that sell them what they want? Think Starbucks, restaurants, automobile companies, autos. If you got an old car, you're thinking about upgrading, you're going to go out and get a new one or maybe a newer one. Well, if you're feeling tight about, you might say, well, I'm going to put that off. I don't need to get that. I'll just go get the tune-up. I'm just going to stick with my old car. I've already got it paid off. I don't need a payment. Those are the types of things that you do. You don't go out and get that new car. You don't go buy that new house. You know what? We can stay in this house for now. Those are things that, Amazon is the biggest company in the XLY. What does Amazon sell us? I mean, they sell us some things we need, but a lot of things we want. How about Tesla? That's the second biggest company in the XLY. Obviously, if you're getting a Tesla, it's not because you need a Tesla, it's because you want a Tesla. So these are the types of things that XLY versus XLP. So when the market's going up right here, we want this XLY, XLP to go up. How about large cap growth versus large cap value? Again, growth stocks, if the economy's strong and rates are low, these companies expand earnings at a rapid pace. And then when you're discounting those future earnings, which you're already projecting to be great, when you discount those back using lower interest rates, those earnings are incredibly valuable. And so that's what drives multiples. So growth stocks, we want to be doing well when the market's going up, because again, it's a risk on kind of a trade. This is another large cap growth versus large cap value index or ratio. So they're very similar. You can kind of see they kind of go hand in hand. Mid cap growth versus mid cap value, and there's small cap growth versus small cap value. Notice how since the April low, or right around the April low, every one of these ratios at the end of October was at or near a high to support the S&P 500. So in other words, although that rally was sustainable. Then we went into a period of weakness and we saw all these ratios go down. That by itself is not a problem. I always say, to me, the more important part of evaluating the under the surface signals of the market, it's not about when the market goes down. Market almost always goes down the same way. Market goes down, aggressive stocks, anything that's been leading the market tends to get hit. We get profit taking. The key is the rebound. When you start going back up, do all of these aggressive areas come back up and lead again, so that when the S&P 500 reaches prior highs or breaks out to new highs, are all of these other ratios moving up to new highs as well? All the way from April to October, for the most part, that's what we were doing. Now I want you to look since April. That's where this vertical red dotted line comes in. I'm separating because now since then, we've pulled back and we've rallied, and we've gone back on the S&P to actually a week ago set a new all-time high. We set a new all-time high close. We got to 6,900 on the close. I want you to look at the QQQ versus a spider. Look at where we are. Did we go back up to highs? No. In fact, we're putting in lower lows. Up here, the S&P has higher lows. Money is rotating away from the more aggressive NASDAQ. How about discretionary? Discretionary went a little bit higher, pulled back. This one's kind of hanging in okay right now. Not bad. How about large cap growth versus large cap value? I mean, again, look at the S&P coming back up, setting a new high. And guess what? Doing it with more and more strength in value stocks, not growth stocks. Growth taking a back seat. Here, look at the large cap growth versus large cap value index here. Same thing. How about mid cap growth? I mean, mid cap growth versus value falling apart. And small cap growth was actually the only one that went back to a new high in December, and then that one started to tumble. So I'd kind of put this in a same category as the XLY, XLP. It's been doing okay, but not great. The others are just straight down. Now, why is it important? Well, let's take a look back at the February top, because we had the same thing going on there. Here was the big rally. Now, the QQQ versus Spider was mostly flat here. But look at the strong rally at the end of 2024 into early 2025. We set a high in January 2025 on the XLY XLP, which is discretionary versus staples. Growth versus value, setting a new high. This occurred in December. Same thing with this growth index, setting a high in December. How about mid-cap growth versus mid-cap value, setting a high in early February. Small cap growth versus small cap value. rolling over in January and into February. And then here's your red dotted line. This is when we set the new high. As we were setting the new high, every one of these ratios was weakening. Every one of them. Even the mid-cap growth versus mid-cap value started to weaken when we hit that final high. And then the market starts to break down. So the confirmation, the technicals are happening after we're getting the warning signs. So this is Wall Street basically moving their money around and rotating into more defensive areas before the market sells off. 2025, not enough of an, reason for you. Let's go back to 2022. So here are the sustainability ratios. Here's the market moving up throughout 2021. Just keep going up, up, up. All the way until about the end of November, the S&P was going up. QQQ Spider going up. XLY XLP going up. Growth, large cap value going up. This is all the way through the end of November, by the way. Large cap growth versus large cap value. The index, same thing. Mid cap growth topped a couple months earlier. That would have been back in September. Small cap growth versus small cap value, same thing. Topped in September before rolling over. And then we get to the final high, that last thrust in the market to the upside. Everything looks good, technically. If you're only following the S&P 500, what's not to like? New high, new all-time high. Everything's great. What's different about this high versus all these other highs? Well, look at the rotation. Here's the QQQ versus a spider. So as we rebounded, money rotated away from the large growth, more value oriented. How about discretionary versus staples? Setting a new high, money's rotating more towards staples. How about large cap growth versus large cap value? Money rotating more toward value. Growth loses its leadership in those last 30 days. There's the mid cap growth. Here's small cap growth. Everything was rotating away. But again, if you look at the S&P 500, all-time high, what's not to like? And that was that's right when we did. Actually, we did it a week later. It was probably right about around in here. So I guess we had just fallen below 4,700 when we had the Market Vision 2022 event. But before the market showed any weakness whatsoever, I said that I thought we were going to go down 20 to 25% within 3 to 6 months. I'm going to stretch this out to June. Actually, we'll go to July. Look at what the S&P 500 did. From 4,800 down to 3,600 and change, almost 25% in 5.5 months. Now, part of it was this. Now, again, perspective, and I'm going to talk a lot more about that when we get into Market Vision 2026 in 2 weeks. But perspective is a big part of trying to call how far we go to the downside. These signals are telling us Wall Street's rotating, but it could be a correction. It could be, it's probably more than just consolidation. I don't think Wall Street would be doing a lot of the rotating that we're seeing right now in the market if it was just going to be a quick little, 2 or 3 week period of consolidation. It's too much money to move around and then to get back in on the into growth for the next big move to the upside. So I think what's happening right now is Wall Street is manipulating everybody. Prices are still looking good on the charts. Everything's going up. But on the flip side, you can see the money rotating underneath the surface. So this is exactly what I was talking about. These are the hidden signals that most people, if they're in 401ks and all they do is just look at the Dow Jones or the S&P 500, everything's good. Market's bouncing back. My accounts are at or near all-time highs. Everything's awesome. No, it's not. And that's kind of, where we need to be, thinking. at this point. So anyway, why don't we take a short break? I'm going to come back. I've got some more signals I want to go over with you. And some of these are fairly new. Haven't talked about them in the past, one of them in particular. So I'll do that in just a couple minutes. John, while I'm taking a break, why don't you take over? And he's going to talk a little bit about Market Vision, the event coming up, and a great sale that we are running. Go ahead.
Tom, thinking of signals, don't go too far because my signal seems to be very weak here. All right. Let me just quickly go over a couple of quick things. Tom had mentioned these, but I think it's really important for people who are new to earnings beats to get a sense of what Tom has talked about during our Market Vision events. And right now, through this year, for example, the beginning of this year, when we had our Market Vision event, the average target across 28 Wall Street firms was 6,500. Tom's target was 7,000, which put him right at the top, pretty much. And at its peak, December 11th, we hit 6,901. So Tom got within a few percent of his projections. And I think that's important. Tom also mentioned he never wavered, never changed his outlook. We saw some wild analyst changes, particularly when we saw that big slump back in April. Everybody changed their forecast. Tom never changed his. And let's take a look at the past events, the Market Vision events. You'll be able to take a look at this and see that Tom has been really accurate. Couple of times, one time we had everybody had a rough 2022, but what's important about 2022 was Tom coming out right at the beginning of the year and saying to people, we got a problem. And so we made sure our members were aware of this. I know we got a lot of great feedback from members saying, thank you for that warning. And, but then, you look at each year, Tom has really been very, very accurate in his calls. And this brings us to Market Vision 2026 coming up. And one of the things we like to do is we like to offer our members, for taking the time, people who are new to earnings beats, it's a tremendous time to save a lot of money. And this is the best sale we've ever had. Normally, an annual membership is $997. We're knocking $200 off and giving you a bonus month. And let me tell you the significance of that. Just attending the Market Vision event alone is $797. So you're going to get 2 Market Visions for free, 2026 and 2027. You can go to our website. You will see there's a link to flash sale. Sign up within the next 48 hours. You'll get the bonus month. You save $200, and you're going to get into 2 of these events. And I can only tell you from the feedback we get, it's our biggest event of the year. So anyways, go ahead, go to our website. You'll see the savings. You won't believe the amount of money you'll save over the course of 2 years. And we have found, by the way, having a membership for 12, 13 months is a great opportunity to see everything that we do. I want to mention, as part of an annual membership, it's a big perk. Every quarter, Tom does an update. So every quarter, Tom is going to take a look at where things stand, tell you what he thinks about the next quarter. We get a huge amount of positive feedback on the quarterly events. But you don't want to miss this coming up. It's coming up on January 3rd. It's a Saturday. It'll be a tremendous event. You'll be able to see everything that Tom's going to be covering. And Tom, I just know from the feedback we get from our members how many people appreciate these events that you conduct.
Yeah, I enjoy doing it. We just started this last year. So we were having the Market Vision event beginning of every year. And then last year we changed. Well, we didn't change. We just added on. So at the end of March, at the end of June, and at the end of September. So you get 3 updates throughout the year. So not only the Market Vision event, but basically it's like little mini Market Vision events.
Yeah.
At the end of each quarter to just in case anything changes. But as John was pointing out, our last 6 Market Vision forecasts, there was really only one where I was significantly off at the end of the year. And that was 2022. And that was because, I had suggested that we were going to have that 20 to 25% cyclical bear market, which we did. But I thought we were going to come straight back up at the end of the year and get back to about where we were at the start of the year. So I was kind of looking for a V, and it went down to June, and we rallied back half of what we had lost by the end of August. And I mean, we were heading back. And then that was when my best buddy, Fed Chief Powell, decided to say that there was more pain ahead. And that was from Jackson Hole at the end of August. And the market turned back down and went back down one more time to the October low, a little bit below the June low, not much, couple percent, maybe 2-3%. And then the big rally that I was expecting in the second half of 2022 actually occurred in 2023. So it really wasn't a bad call. It was just the Fed did their Fed thing, which is what Fed Chief Powell likes to do. The waffling, the can't follow him. It's, the Fed's supposed to be about transparency. That's what Fed Chief Bernanke did back, many years ago. His whole thought process was, well, we want to try to be as transparent as possible because then we won't have as much volatility in the market. If Wall Street and all the folks out there know what we're going to do ahead of time, then when we do it, there won't be as much volatility. Well, that all worked great with Bernanke and then even with Yellen. But since we've gotten Powell in 2018, I've never seen so much waffling. He can't even get his own folks at the Fed to agree on anything. And so the market's been incredibly volatile. He's the only Fed chief that has presided over 4 cyclical bear markets, and it's only been 7 years. So, I mean, I could go on and on, but that's not really what this is all about. But the point is, with the flash sale, if you take us up on this flash sale by extending 1 month, so instead of 12 months, which would run through next December, the 13th month gets you into the middle of January 2027, which will be after our Market Vision 2027 event. And any annual member, all of our annual members come to these events free of charge.
Yeah.
So that's a big deal.
I want to mention one other thing too. If you like the information today, you just wait till the Market Vision 2026. It's going to be elaborate. And a lot of things can change, by the way. We've done this before between now and January 3rd. So if you think that you're learning everything that's possible, just wait till the Market Vision 2026. Anyways, go to our website. You'll see at the top, flash sale. If you're going to do something, if you want to be part of Earnings Beats, which we'd love you to, just do it. Sign up now, and we'll be seeing you at the Market 2026 event. All right, Tom.
All right, let's get back into what we're doing here. Give me 1 sec. All right, so let's move on. So next up, I want to show you, so we talked a little bit about those sustainability ratios. I want to show you just real quickly why these sustainability ratios are important. One of the things that I did is I went back and I wanted to make sure that the correlation between the direction of the S&P 500 and the direction of those sustainability ratios is mostly positive. I mean, if over history, the S&P 500 and the sustainability ratio that I'm using are going in opposite directions, then they're not telling us anything. But what you can see here at the bottom of each one of these charts, I'm going to go through this quickly because I want to move on. But down here at the bottom, this is the correlation between the directional move of the S&P 500 and in this case, the discretionary versus staples. This is one of my favorite sustainability ratios because I think discretionary versus staples tells us a lot because our GDP is 2/3 consumer spending. So if our GDP is 2/3 consumer spending, it just makes common sense to me that we want to make sure that money is rotating into the right area of consumers, of the consumer stocks. So if you look down here at the bottom, this tells us anytime you get a correlation coefficient at 1, that means basically that whatever you're comparing, they head in the same direction. It's hand in hand, absolutely all the time. That's what a reading at 1 means. A reading at -1 means that they move exactly opposite. Look how many readings we've had at -1 over the last 5 years. This is a daily chart. The reading is for 20-day periods. It's a 20 period. That's what that 20 is right here. So it looks back over 20-day periods. There has never been a 20-day period where they have gone exactly opposite. That's only 1 month. We've never done it in the last 5 years. And if you look, the reason I shaded this, I shaded the area above positive 0.5 to highlight how positively these two are correlated. Down at the bottom, I showed you all the times where we've moved below minus 0.5. You can count them on one hand, almost on one finger. Maybe you got just a little bit there. But you can see we pretty much live in the plus 0.5 and above. So that's just further confirmation of what a great signal the XLY-XLP ratio is in determining the sustainability of a move in the S&P 500. Here is the QQQ versus the spider correlation here. So again, here's the S&P 500. Here's the QQQ versus the spider. And here's that correlation. Mostly, again, in the blue shaded area. Very infrequently do we move down in that red shaded area. How about large cap growth versus large cap value? IWF, IWD, right? Here's the S&P 500. Here's the IWF, IWD. And check out the blue shaded area. Again, very, very strong positive correlation. Now, the beauty is that not all of these sustainability ratios go up and down at the same time. So occasionally, the S&P might be going up and one of these ratios may not be supporting it, but others might. But it's when the S&P is going up and they all start turning in the other direction, I'm showing you that the inverse correlation doesn't happen very often. And when all of a sudden we start to see some inverse correlation and it's across all of our sustainability ratios, that to me is what makes it so significant. Here is the mid-cap growth. Here's the S&P 500. Here's mid-cap growth versus mid-cap value. You can see the blue shaded area. So we're starting to see a little bit less. So when I look at this, I would say, okay, the correlation of this one is not as positive as, say, the XLY-XLP or growth versus value, large cap growth versus value, which makes sense because the S&P 500 is made up of large cap companies. Mid cap has their own index, but still growth versus value is meaningful, even at the mid cap level. And then small caps, kind of the same thing. Oops, I didn't do the small caps. I'm sorry. But it would be similar to the mid cap. So now what I want to do is I want to show you cryptos. So this, again, cryptos is not something that I really follow. I don't trade it. You can only be an expert in so many areas. The stock market, the U.S. stock market is our focus. It's very, very wide. It's very, very difficult. It's very, very complex. And so I focus all of my time and efforts on trying to figure out signals that help me with the S&P 500. Now, one thing you have to understand about Bitcoin is that Bitcoin is a risk asset. So if we're looking for, if we want investors and traders to be in a risk-on environment or have that kind of an attitude, Bitcoin would kind of make sense, right? So I thought, well, let's take a look at the correlation. Let's see if it makes sense. So Bitcoin started back in 2014. And here's the chart of Bitcoin to the US dollar. And then down here below, what I have is the correlation of Bitcoin and the S&P 500. So in other words, do they move together to the upside and downside, or do they move opposite? Well, what you see in this blue shaded area over the last 11 years is that there's a lot more trips up into the plus 0.5 to 1.0 range than there are in the inverse or negative correlation, minus 0.5 to minus 1 range. So I think we can conclude from this that Bitcoin does offer us up some nice clues. In other words, if Bitcoin's going up, it's telling us investors are in a really good mood and willing to take a lot of risk. And that's the same environment that makes bull markets work. So that's the good news. The bad news is here where we look at Bitcoin at the top and we have the S&P 500 down here at the bottom for the last 11 years. The interesting part here is that I want you to check out, well, first of all, go back and check out when we've had weak periods in the S&P 500. I've highlighted them. The only one I didn't highlight was 2020 with the pandemic. I mean, how is Bitcoin going to give us a signal on the pandemic? So I just ignored it. Although Bitcoin was going down before we actually peaked in the S&P 500, it started taking a hit earlier. And that's kind of the point with all these red shaded areas. I want you to look at when the S&P 500 has struggled, either gone sideways with volatility like we had back in 2018, the 2022 bear market, 2024 into 2025, where we had that cyclical bear market. Notice every one of these situations, Bitcoin topped and started going down before the S&P 500, right here. Now, this is actually a period where the S&P held up okay throughout most of this move. But when we did finally top at the end and move down in 2015, I mean, if you remember 2014, 2015, it was sideways. Really from the end of 2014, we didn't do a whole lot. Maybe went up a little bit, kind of went down, then we set a low to start 2016 right here, and then the market went up. But throughout this period, Bitcoin was weak. But let's fast forward to some of these other periods. So in 2018, Bitcoin topped actually at the end of 2017 and had a rough year in 2018. Well, so too did the risk assets when you look at the S&P 500. We started off, and by the way, at this top right here at the beginning of February, maybe at this point it's no coincidence, that top was right when Fed Chief Powell came on board, February of 2018. We immediately went down. That was probably a little bit of a warning of what we were going to see for the next 7 years. But anyway, went down, we came back up, and then in the fourth quarter came down. But the whole time, the risk asset of crypto, Bitcoin, was weak. And the market struggled. Look at 2021. We actually topped, it looks like the end of October, maybe early November, and started going down pretty significantly into the beginning of the year. Beginning of the year is when the S&P 500 topped. So we were already starting to go down pretty significantly in Bitcoin before the S&P rolled over. How about at the end of 2024? Bitcoin actually topped in 2024 and started rolling over. And the S&P 500, remember, topped at the beginning of 2025. It was February 19th, 2025. So once again, Bitcoin topped and started rolling over, and then the S&P followed suit. Guess where we are right now? Bitcoin topped back probably end of September, has been going down, and right now it looks like we're putting in a top. We'll see. Like I said, tops are a process, but it looks like the S&P 500 could be topping. And if history is any guide, watch Bitcoin, because if Bitcoin's been holding in around 85,000. We bounced, and right now we're at 88,000. So we're kind of moving back up a little bit. If we go back down and break down below 85,000, I think that's going to be another nail in the coffin for the S&P 500. So Bitcoin is another signal to kind of keep an eye on. Now let's talk about semiconductors. Why are we going to just talk about one industry group? Just one industry group? Well, it's one industry group that's 27% right now. I just looked it up this morning. 27% of the NASDAQ 100. And semiconductors are 14% of the S&P 500. So as goes semiconductors, it's going to be really difficult for the stock market to do anything other than follow semiconductors. Now, semiconductors, if you look at the chart, this is kind of interesting, but semiconductors, when they go down, so you can see the semiconductor index back in 2015 went down, You can see S&P 500 struggled. Here we went down in 2018 and we had a cyclical bear market. Here we went down in 2022 pretty significantly, and that was a pretty deep cyclical bear market. And then 2025, pretty significant decline again in semiconductors, and that was accompanying that correction that quickly morphed into a minor cyclical bear market. And I say minor because it literally hit like 20%, and that was it. And it just quickly turned back to the upside. But I want to point out a couple of things here on this chart. Number one, the monthly PPO has never been as high as it was in 2024. And right now we have negative divergence. So we've gone to higher prices and the monthly PPO has already started to roll over. So we have a long-term momentum issue with semiconductors. And I mean, if you, again, use some perspective, I'm not saying AI isn't great. I'm not saying semiconductors aren't great. I think these are absolutely the most fascinating companies in the world. What they produce and what they do for us is absolutely pivotal. I mean, it's incredible. So I don't want anybody to take away that I think semiconductors are, horrible and that they should never be going up. I think absolutely they should be going up. And some people are comparing it to the dot-com bubble. I don't think it's anything like that. Many of these AI companies, their earnings are absolutely exploding to the upside. You look at companies like Palantir and their growth on their top line and bottom line. I remember the dot-com bubble. Companies would lose $200 million. Stocks would just go up. They were incredibly overvalued with no earnings, and they'd split. And when the split would come out, market would just absolutely just go crazy over it. I'm a CPA, former practicing CPA. A split is nothing more than getting twice as many shares, and then the price of the stock goes down in half. There's no impact other than making it more affordable, which can have a little bit of an impact, but fundamentally, it's really no change in the business. That's what was going on with the dot-com bubble. It was ridiculous. These companies were losing money hand over fist. They were throwing extravagant parties. They were buying naming rights of stadiums, and they were making no money. These AI companies are making money. There's going to be a lot of use for these companies going forward. Already companies, I mean, I know I've talked to Chip Anderson at Stock Charts, and they're using AI in so many ways to improve their website at Stock Charts. So it's here. It's not going to change, but you go through periods of euphoria where they're overvalued and they just need their fundamentals to kind of start to catch up to price. And then meanwhile, price comes down, fundamentals go up, and at some point we meet and then we take off again. But right now, I think semiconductors are incredibly, what I've been saying is it's a very crowded trade. Everybody is in on them. And the problem is when you get the masses, when everybody's in on them, who's the next person to come in or the next group to come in and drive prices higher? We'll have some new money coming in the market, but if everybody is already in that trade, we probably need to let a little bit of air out of that. I don't want to say bubble because I don't mean it in that way, but we need to probably should use a little bit of a pullback. Now, for the first time since April, we saw November put in a lower monthly low than the prior month. Right here. So after six straight months of higher highs and higher lows monthly, we actually saw a little crack in the foundation. That's number one. Number two, again, the negative divergence, slowing momentum. But here's number three, and this is going to be very, very critical to watch going forward. But do you notice that the weakness in the semiconductors and the resulting weakness in the S&P 500 basically occurred after the monthly RSI moved out of overbought territory? So in other words, we were very, very overbought but we kind of start slowing down and teetering. And then once we start to roll over just a little bit and we get a breakdown of that, the overbought conditions, that tends to spark a bit more of a sell-off in semiconductors, which then creates problems for the S&P 500 because it is the largest industry group within the S&P 500. If you've got 14% of the S&P 500 starting to go down like you see in these red shaded areas, the other 86%, and by the way, if this is happening, probably other aggressive growth areas are probably doing something similar. So it's not just 14%, but these are the leaders. S&P or the semiconductors are the leaders because it is the highest market cap group. And so when we start seeing weakness, it generally is going to take the S&P with it. So I'm looking right now, look at these black directional lines that I have in here, pointing to when we go down below RSI 70 on the monthly chart. And when that occurs, in the past, when that has occurred, every time when it has occurred, we've seen more selling in semiconductors. Now, right now, the monthly RSI is sitting at 73. It was up in the mid 80s. So it's coming down. But if you're starting to look for confirmation of some of these warning signs that I've been talking about today, that would be another one. Monthly RSI on the Dow Jones Semiconductor Index. If we break down below that 70 level, it's just a signal. This is what's happened in the past. This comes from studying the market and what has driven the market lower in the past. This is one of those signals, so be careful. All right, here is a 2-year chart. And what the top part of the chart is semiconductors divided by the S&P 500. So this is showing us the role that semiconductors have played in the S&P 500. This is just the last 2 years. Whenever we have seen the market go up, now, and this doesn't happen on every single occasion. You can see here we broke out August to September, and we had lower number here, and we kept going higher. So it's not like every single time we have a negative divergence, the market comes down. However, every time the market has come down, we have had a negative divergence. So the fact that we currently have a negative divergence, the S&P has gone back to a new all-time high, but it has not been a new all-time relative high for semiconductors. In other words, something else is leading the S&P. And when that has happened, each one of these big moves here was, well, we'll see what's going to happen coming up in 2026. And how, like John said, things can change. So what's going to take place between now and the beginning of January, I'm going to be watching it very closely. But look at what happened in February before the big decline. The S&P went up. Semiconductors lost their relative strength before the market went down. Some people say you can't predict the market. I say hogwash. We've been doing it for 7 years. Nobody's been doing it better than us. But look at this. Back in June, July. Now, this was before the market had a correction last summer, like 2024 summer, not 2025. Look at the last move up. So anytime you see the S&P going up and the semiconductors rolling over, it should be a warning sign. Doesn't mean we're going to keep going down, but it's one warning sign. And as you get more and more warning signs, to me, the risks are growing. If you get one warning sign, if you follow 10 signals and you see one warning sign, I would probably just ignore it. I mean, it's telling you, okay, maybe that there's something there, but probably not. And we, continue to see the market moving higher and so forth with the other sustainability ratios going up. But when you start seeing warning signs and they happen to coincide with other warning signs, it's starting to beat you over the head. So what I always say to members is, do you really want to take the chance of being in the market? It's not about a guarantee that the market's going lower. I can't guarantee anybody anything. It's about the risk. If you're in and you've got limited upside and you've got the potential for increasing downside, do you want to stay in? Now, for somebody who's long-term, I would say, if you're not a trader and you're like, well, Tom, where are we going to be in a year from now or 2 years from now? And if I say, hey, I think we're going to be at all-time highs, you might say, well, fine. I don't want to do anything. That's where I think we're going to be in a year or two. I don't think we're going to have any issues. I think we're going to be back at all-time highs. But what if I told you over the next few weeks to a few months, what if I said we might have a 10% or the risks are increasing that we might have a 10% pullback before we go to all-time highs? As a trader, that might make a difference to you. To me, how you interpret it, what you do with the information is completely up to you. This market might just ignore these signals and keep on trucking. So you might sit back and say, well, if I get out and the market keeps going up, when do I get back in? I don't want to do that. Well, then stay in. I don't know. I can't tell you for sure which way the market's going. I can only tell you that there are a lot of warning signs out there. And this is another one. I mean, again, when you look at every one of these signals, each big decline, this big decline, this big decline, this big decline, and I don't know what we're going to get next, but if we get another big decline, they will all occur after we had a negative divergence on the relative strength of semiconductors. That's how important this group is. All right. Here's a channel. Now, as we go in, and this is where perspective, I'm just going to give you a little bit of what we talk about at Market Vision. Back at the beginning of 2022, I saw all the warning signs with the sustainability ratios, right? Well, if you study history, you know that during secular bull market advances, we tend to average going up about 12, 13, 14% a year. Since 1950, we've averaged going up 9% a year. When you're in a secular bull market, you get into a channel where your returns are much better than average for an extended period of time. It's what I consider a grand super cycle. And then when we go into secular bear markets, we'll go through 10, 12 years of torture where we never see an all-time high for 10 or 12 years. That's what we saw in the 2000s. We had a nasty bear market, 2000 to 2003. Then we recovered. I think we might have made a slight breakout, very, very slight, but really it was like a double top. And then we went back down and put in a lower low, had another nasty bear market. I'm not talking 20, 25%. This was 50 and this was 60%. That's secular bear market stuff. We're in a secular bull market. But if you connect the lows and then you take that line and drag it and connect the highs, it kind of gives you a channel that we run in. The new highs and the new lows keep going up higher and higher. Look at the end of 2021. We broke out of the channel to the upside. Now, knowing that we generally have pullbacks to test the middle part of this channel, done it multiple times, going into 2022, this was one of the things I pointed out. Folks, how bullish do you think things are going to get? We just ran from 2,200 to 4,800 in a year and 9 months. It was the largest 21-month run on the S&P 500 since the 1929 crash. Again, perspective. Everybody's bullish. We had people in 2021 who had never traded before. Remember, we were all stay at home. People trying to figure out new stuff to make money. We had people coming in trading, thinking all you had to do, it was like a casino, except, 3 cherries would always come up. And so we just kept making money. And so the options world sentiment got so complacent. And we were outside the channel. And all of our sustainability ratios started falling apart. That's when I went in and I said, Folks, this ain't good. 2022 is not going to get off to a good start. The only thing missing is for our indices to start breaking down. And so I gave levels, and I said, if these levels go, we're in trouble. And I think on the S&P 500, I said, maybe we go to 4,300. That would be a correction. I said, maybe we go to 4,300 and that's it. If we go below 4,300, game on. Well, rest is history. We went down to 4,300. We bounced, went down back through 4,300 and went down to 3,500 and change. Actually, 34 something, I think, was the ultimate low. 34.91, I think, in October. Right here. Intraday. So look at where we are right now. When we started 2025, and I said beginning of the year I could see a correction. Look at where we were starting 2025, right near the top of the channel. Where are we at right now? Top of the channel. Now, we rode the top of the channel for over a year and a half back in 2014, 2015. Wasn't the most exciting market. Upside was limited, but we did kind of just ride up with that upper channel line. That might be what we're in for. That's where we are right now. But again, upside to me is limited if we're already at the top of the channel. But what about the downside? Well, warning signs are out there. We're going to talk a lot more about this. And believe me, when we talk about Market Vision 2026, I'm going to be talking about inflation. I'm going to be talking about interest rates, the 10-year Treasury yield. I'm going to be talking about the dollar and where I think the dollar is going. Of course, that's going to impact gold, silver. I mean, we're going to cover all of these different areas. Are there international markets that look better than the S&P 500 right now? Going to talk about that. Going to talk about sentiment. If you want to know why I thought the market was going down as much as I thought it was going to go down, if you recall, if you're a member and you were at that 2022 Market Vision event, you will recall me saying the biggest problem, it wasn't sustainability ratios. It wasn't the fact we were outside the channel. The biggest problem to start 2022 was sentiment. And I'm going to be talking about sentiment a lot in 2 weeks. So you want to keep that in mind. Anyhow, that's basically what I had for today. We've gone a little bit over an hour. Still plenty of time to get to your favorite watering hole if you want to go watch the college football playoffs. I'm going to bring up that flash sale one more time. You can kind of see right there if you go to our website, earningsbeats.com. Can't miss it. It's right in front of you. Earnings Beats, both plural. Earningsbeats.com. If you click on this, it will take you to this page where you've got 48 hours, a little bit over 2 days right now, to take us up on the best offer you're going to get. And the reason is because the timing. We're going to throw in an extra month, which gets you to January, middle of January 2027. That will be beyond the date of our 2027 Market Vision event. So this deal to sign up and become a member for 13 months will automatically get you a seat into the 2026 Market Vision event in 2 weeks and the Market Vision 2027 event in a little over a year, plus the quarterly events that we do, March, June, September, and then everything else we have in our service, which is crazy. We do a lot of research for our members. And by the way, our portfolios, which have crushed the S&P 500. I mean, if we go in here, you scroll down and click on the historical performance. We're in cash right now, by the way, in our portfolios. But before we went to cash, look at where, what we had done in our portfolios. This is where the S&P 500 is right now. So as far as I'm concerned, like with the aggressive portfolio, the S&P 500 is going to have to go up 5% just to catch where we were when we went to cash. And with the model portfolio, we're probably going to have to get up to 7,000 or close to it just for it to get back to where we went to cash. And so we're patient. We're disciplined. We know that there are issues out there. We're not listening to CNBC. I could care less what Goldman Sachs has to say. I'm going to watch what Goldman Sachs is doing on their charts. That's what we talked about. That's where we're different than everybody else. We're not registered investment advisors. We're educators. So that's the way you should approach us. We have, when anybody asks, what do you do at Earnings Beats? We're a guidance, research, and education firm. 3 pillars: guidance, market research, market education, not investment advisor. We're going to help you learn about the market. We're going to help you manage your own money, because we're going to give you signals that give you better clues than anybody else on Wall Street's going to get. That's been our history. And if we've got members in here, I want you to post, and I want you to tell folks about, it's one thing for me to say how great we are, but we've got members who have been with us since 2004. And they can certainly tell you. One last thing, again, I want to remind you, please, please, please click that like button. This is a free event. We're giving out a lot of great information for free. You can help us, even if you don't sign up. You can help us by hitting that like button and subscribing to our channel. We do free live events from time to time. If you subscribe to the channel and you turn your notifications on, if we start an event, you'll be notified. And we give away a lot. Probably too much. But that's one of our missions of our business, is to help educate. And if we just cater everything to paying members, those outside the paying members don't really see what we do. That's why we like to have events like today. So you have anything to add, John? I'm running out of voice.
No, I think you pretty much covered it all. Go to our website, hit that flash sale, get involved with us. I think it'll be one of the best decisions you ever made.
There you go.
Also, if you have your mobile device, you can use this QR code right here.
Yeah.
Appreciate it. That's Matty Slice, everybody.
And by the way, if you liked what you saw today, just wait till Market Vision. It's so much more encompassing. It'll get you set up for next year. And those quarterly updates that Tom will keep you really ahead of the curve. And by the way, when you go to our website, just look at the feature. Tom has a daily market report. So it's not just quarterly. Every day, Tom is in touch with our members. He has a weekly report to get people set for the whole week. Then we got our daily report. The charts are unbelievable. I've been working with Tom 20 years, and I learn something every day. So get involved with us. I think you're going to find that it's going to be well worth one-time investment.
Yeah, and I would just say, John, I learn something new every day. The market is always changing.
Yeah.
And we don't stop. Our research never stops. The information that we provide to our members, I've got a Excel spreadsheet where we have like 20 or 21 individual stocks where we're kind of tracking everything that happens on those stocks intraday, four different times during the day, trying to figure out accumulation versus distribution. And we let our members have that information. This is proprietary information and research that we do, that we give a lot to our members, annual members in particular, because they're committing to us. And so if you're going to commit, and by the way, probably 95% of our members are annual members. We got a few monthly, few trial, but most people love what we do, and they come on board and they want to check us out for a year. And then once they come on board, they usually don't leave. That's been our history. So anyway, appreciate all the members responding right now. Giving us the kudos, hopefully, that we deserve. I think we do. And again, just so many folks from all over the world coming in today. Thank you so much. I know you're taking a lot of time out of your day. Hopefully it's worth it. I think this stuff is worth it. So, all right, that's it. So hopefully I'm going to see every one of you back on Saturday in 2 weeks for our Market Vision event. That's where I'll actually give you my forecast. I'll tell you during the day or during the year, whether I think we're going to have X correction or whether I think it's going to be a bear market. I'm going to give you my end of year forecast where I think we'll be. And if you saw that slide earlier, been pretty darn close. I surprise myself sometimes how close we've been on our forecasts without adjusting during the year. So anyhow, have a great rest of your day. I actually went to high school not too far from JMU, James Madison. They're playing Oregon later today. So I got to say, even though I didn't go to JMU, I got to say go Dukes. Hoping not Ducks, Dukes. So hopefully the Dukes take out the Ducks, but I know that's a long shot. But anybody in here from that area, definitely going to be thinking about JMU and Harrisonburg, Virginia. I went to high school 15 minutes from there, just north of Harrisonburg. So anyway, have a great day, everybody. And thanks again for coming in. See you in 2 weeks. Happy trading.